Welcome, everybody. Welcome to the show, the episode, the podcast. As always, I'm here joined by my colleague, Jake Sadler. Jake, how are we doing today?
All right. Yeah, doing well. Yeah, no complaints from the management.
Well, good. I'm glad to hear there's no complaints. Last week, we talked about this big topic of required minimum distributions, which is taking money out of your retirement accounts on a regular basis. And we're going to take a step back today, I think, and we're going to talk about two things, actually. Number one, we're going to talk about the topic of rebalancing your portfolio. And we're going to talk about doing it in a tax-efficient way, which means potentially using some of these accounts, these retirement accounts that are available to us to hold our investments. And so we're going to, which then will require minimum distributions in the future. So we're taking a step back is what I'm trying to mumble around and say, and talk about rebalancing and tax efficient investing, which is something that is really exciting to us.
Yeah, except it's like the most boring word in the world. It's like, we get all excited when we talk about rebalancing, and rebalancing as a word is, it just sounds really boring. Like, that's like a core of what we do is rebalancing, and it just sounds very uneventful and unexciting. But I think it's pretty exciting.
Could you imagine going to a cocktail party and somebody asks you about your investments and start talking about rebalancing? I mean, it would be awful. So obviously,
No, it would be terrible. Yeah, that'd be a quick way to end the conversation right there.
Yeah.
We rebalanced the portfolio today. That doesn't sound too.
I mean, at least talk about Tesla or something like that. You hold it in your portfolio somewhere, so you can say you bought some Tesla when it was low. All right. So you want to start out and give us a little bit of an explanation of what actually a rebalancing is, what we mean by it?
Yeah. Let's talk about rebalancing. Get the idea, and so rebalancing. This in simplest terms, rebalancing is the exercise in managing your portfolio that brings your mix of investments to its target. So there's a lot to unpack kind of within, this simplest definition. So you kind of want to keep your original percentage or mix of investments the same, and you do that, through rebalancing. And I think the way to think about it is this: if I am starting an investment approach and I'm building a portfolio, and let's just say I want to hold 70% of my portfolio broadly in stocks and 30% of my portfolio broadly in bonds, I can on that first day, I can get that portfolio invested exactly to 70% stocks, 30% bonds. But the next day, it's going to be different.
Yes.
The market's moved. So that's the thing about investing. It's dynamic. It's constantly changing over time. And so we have to, monitor the degree of change, or drift, as we sometimes call it, away from our initial and starting mix of investments. And from time to time, we see so much drift, or there may be a certain event where we need to rebalance or kind of bring our investments back to their target. So sell what's up in value or up in proportion to your target, and buy what's either down in value or down in proportion to your target.
So let me stop you right there, if you don't mind, and let's just talk about why we want to rebalance. I mean, so we've gone through and picked this 70-30 portfolio account allocation. I assume for some reason, and
I don't know. Hopefully that doesn't mess up our math as we're talking about it.
We should probably go with 50-50.
It could be 50-50.
Yeah.
Yeah, 50-50 is easier. Probably.
Yeah, let's start with a 50-50 portfolio. And so when we think about like what a 50-50 portfolio is, like you said, it's 50% stocks, it's 50% bonds. But why did we pick that portfolio? We want to tie our portfolios into what type of returns we need to achieve our objectives. Number one. Number two, we want to tie our portfolios into our risk tolerance. What will allow us to sleep at night, what type of risk we're willing to take, and quite frankly, what type of risk we have the ability to take. And those are two different things. So we go through this financial planning process, and we look at somebody's situation, and we say, hey, we think this 50-50 portfolio would be a good fit for you. Like you said, after a certain period of time, that portfolio changes and it might go to 60-40. So what's the big deal? Why do we want to rebalance? I'm asking you.
Well, the idea is to control. Yeah, I thought you were going to tell us. The idea is to control risk. So rebalancing in that example, if you've gone from 50-50 to a 60-40 stock to bond mix at that kind of highest level, mix of stocks and bonds, we want to rebalance in part to control risk, to bring us back to a level of risk that we have determined in advance is appropriate for our situation, what we need to get where we want to go, but not more than we need in terms of risk that we can kind of tolerate. So it's really in large part an exercise to control risk, but it's also a way to kind of provide some structure into your investment approach that allows you to kind of tune out the noise, so to speak, and avoid market timing. So it's kind of systematically, you're selling what's up in value, buying what's down in value. So it's kind of systematically buy low, sell high.
Yeah, no, I love that. It gives us the ability to sort of time the markets from an analytical perspective. And so we're not saying, hey, is the market high at this point in time? Is it going to go down tomorrow? We're saying, hey, the market's higher than it was, a month ago or a quarter ago. Let's take some of those returns off the top, not all of them, and let's put them in something that maybe hasn't done as well. And so that's, like you mentioned, just in practice, it's selling high and buying low. So that's what gives us positive investment returns over time. And we can do that from a equity fixed income perspective. So like our total equity portfolio may have gone up and maybe our bonds didn't. So we got to sell some and buy it. But we can also do it within those asset classes of the equity portfolio. And so maybe, like 2 years ago or 3 years ago, one of the mega caps, the FANG stocks did really, really well. So in theory, they go up, we sell some of those, we put them in small cap or value, which didn't do so well. And then those go up the next year. And so that's, we have that ability to rebalance a portfolio and take advantage of, I guess you can say, take advantage of some of these opportunities to control our risk and maybe sell high and buy low.
Yeah. And I think that touches on two really key and fundamental parts to this whole exercise, because in a lot of ways we can simplify kind of what we're doing in terms of, okay, we have an overall mix of stocks and bonds. Maybe we want to hold it for a long period of time. That mix is aligned with our objectives as an investor, and rebalancing allows us to maintain that mix over time. But two really key elements to this investment strategy are establishing that initial allocation. And you touched on this kind of earlier on. It is really essential to this whole exercise of rebalancing. To, if you are starting on a new investment approach, really getting into the weeds on, okay, what is my mix of investments going to be? What do I need it to be? What can I tolerate? And working with a professional in a lot of cases goes a long way in helping to establish an appropriate mix of investments, an allocation that's suitable for your goals. And that mix, we talk at the highest level about stocks and bonds. But really, when we're in there in the weeds, we're looking at over a dozen different kind of sub asset classes that we need to work with and rebalance or take into account when we're rebalancing. So to your point, a year where say mega cap stocks have really done well in our rebalancing exercise, we need to sell those. And maybe we're underweight in small cap or mid cap. So we need to buy more of those. We need to factor in that mix of US stocks and international stocks, both developed countries, emerging markets. So the list kind of goes on in terms of these kind of sub asset classes that are important to pay attention to in your allocation.
Yeah, no, I love that. So there's a lot going on. There's a lot of things to think about when we're rebalancing. And we've touched on like when we start a portfolio, when we first do our initial investments. What are some other times that you think about when we might want to rebalance a portfolio that aren't like market related, where we want to look at our risk, maybe that was at 70-30 and go to a 50-50 or any other opportunities?
Yeah, no, I mean, I think a big part of this is regularity. So, consistency, market movement, that's the obvious one. Okay. And it's important when you are, embarking on this investment journey to kind of set some parameters for yourself for rebalancing. So say, okay, if I drift 10% on either stocks or bonds in my allocation, that's my signal that we want to go ahead and do the rebalancing. So market movement with parameters is really important. But I think, again, consistency and regularity is really important. And there's a lot of evidence out there that shows, okay, at a minimum, do your rebalancing once a year.
Yeah.
So, try to get yourself as close back to your target as you can at least once a year. You can certainly do it more frequently than that. We'll talk about circumstances where you may want or need to do that. You don't necessarily need to be doing it daily. That's going to be, kind of from a management and cost perspective, probably not going to be compatible for most people. So at least once a year. And the difference between rebalancing every day versus rebalancing once a year, it's pretty incremental. So you can get most kind of the best bang for your buck by doing at least once a year. I think other opportunities for rebalancing, big life transition. So I mean, you kind of think about retirement as one of those examples where you're shifting from an accumulating phase to kind of decumulating or consumption phase from your portfolio. Good opportunity to rebalance. And it's at that point in time where, in particular, you really want to be mindful of how much cash you are positioning in your portfolio. So this is a really key part of the rebalancing exercise is for folks that have a distribution need from the portfolio. Taking that into account when you are doing your rebalancing. And I think it's really, when you kind of grasp this concept of rebalancing and then pair it with paying yourself from your portfolio, it can make a lot of sense. If you're staring at your portfolio, seeing it move day to day and thinking, okay, what's the best time to get my cash out? I've got, monthly expenses. I've got things on an ongoing basis. Jim's kids are calling him on the phone there, asking for money. So you've got all kinds of, cash needs that you need to account for. And in that process where you're rebalancing, you say, okay, what's up in value or up in proportion to my target? Let's sell that. Let's replenish my cash that I need for the increment that I'm planning for, whether it's 6 months or a year ahead, position that in cash, and then buy what's down in value or down in proportion to the target. So distribution is really key in the rebalancing, and that's something to take into account. So I think the very last one that I'll point to is if you do kind of have a windfall or have the ability to put an amount of money to work a new amount of money to work in your portfolio, it's a good opportunity to review your rebalancing.
No, yeah, those are the
And put that money to work where it needs to go.
Yeah, those are the key times. When you're taking money out, you're looking at your portfolio rebalancing. Also, when money's coming in, through a windfall, or one of the things I like to do is if you're adding on a regular basis, cash accumulates. You look at your portfolio, you use that money to rebalance instead of just like buying the same thing every single time. You sort of use it as an opportunity to rebalance. All right, so we sort of beat that a little bit. What are the problems we run into when we rebalance? I can think of one big one that sticks out in my mind, and it's taxes.
Yeah, taxes definitely. I mean, I think and I think this is a good opportunity to point out this is not a one size fits all type of strategy. So rebalancing kind of at the highest level conceptually, this can work in many, many different situations and many, many different portfolios. But the implementation of rebalancing is going to differ and it's going to be unique to your portfolio. And so that's where I think where we see, okay, what are the issues? It's going to be unique to you. And what are the issues as it relates to taxes? That's going to be unique to, your own personal circumstance. If you have, say, for example, your entire portfolio is in a taxable account, a brokerage account, and it's not in any tax deferred accounts, well, rebalancing is going to involve trading, and trading is going to trigger, capital gains in a, say, taxable account. So you have taxes to contend with in a taxable account, and so your mix of account types plays an important role, especially in kind of the uniqueness of your ability to rebalance from year to year.
Yeah, looking at a taxable account, it's not easy to rebalance a portfolio if you're worried about taxes. Now, some people don't worry about taxes, but they play an impact on your investment returns, and so you really do need to think about taxes. And so you don't want to just sell something and not take taxes into consideration. And so that's a place where I would really look at new money coming into a taxable account and say, hey, let's use this new money to rebalance instead of selling something to rebalance. And then we'd also want to look at opportunities maybe when there's losses in the portfolio from down markets. You can sell those, you can realize those losses, you can set them aside and just know they're there when you have opportunities to rebalance. So it's not super easy. And a lot of times what we see, I don't know if you see this or not, but you see a lot of drift in portfolios. It's, a taxable account, which starts at a 50-50. You look at it on a regular basis, and 20 years down the road, it's 70-30 because you lose the opportunity to rebalance if you're worried about taxes.
Yeah, that's where tax sensitivity comes in. And I think in a lot of ways, rebalancing is this kind of ongoing systematic process, is kind of illustrative of kind of the ongoing nature of just managing your financial situation. So it's important. I think the example you gave is, okay, if you have a taxable account or the taxable account assets are factoring it heavily to your portfolio and your rebalancing decisions, having an eye for your cash flow and how much money can come into the taxable account to allow you to rebalance through new contributions rather than through rebalancing through trading that would trigger capital gains is important.
Yeah.
So it's really kind of where the rubber meets the road in some ways, with the management of the portfolio, the management of the capital gains, with the income tax picture and the financial planning picture. Really all need to be integrated.
Yeah, no doubt. Other place in taxable accounts we look to rebalance is we don't actually reinvest dividends a lot of times. We let those get paid out in cash, and then we take those and look at the portfolio, look for opportunities to rebalance. So that's just in a taxable account. Let's touch a little bit on these more tax efficient accounts. Like if you had all your money in a retirement account, the conversation we just had goes away. You can buy and sell with no tax implications, and it's really easy to do. Costs have gone way down now, and so there's not a lot of trading costs anymore. I mean, there's trading costs, but they're less than they used to be, and so it's a pretty easy thing to do when you just have all your money in an IRA. But there's other accounts that we got to take into consideration. We have Roth IRAs, we have HSAs, we have 529 accounts. Those sorts of things. So do you have a perspective on when you have a brokerage account, an IRA, and a Roth IRA, like how to look at that?
Yeah. So in the example, we have a portfolio that has a brokerage account or taxable account. We say 401k or traditional IRA and a Roth IRA.
Yep.
So it's kind of three different kind of tax types. That's where, a lot of times we try to take advantage of what we call asset location in terms of positioning different types of investments in different types of accounts. And that's kind of a lot of the conversation we have. But I think in this example, when we're talking about rebalancing, a lot of times the way that we kind of end up managing this set of accounts is we allow for drift in the taxable account. So just to your point, say you got your 50-50 starting allocation, mix of stocks and bonds, it's drifting up as say stocks go up in value. Now that's 60-40 or 70-30. But you happen to be in a pretty high tax bracket right now, and it's not really the best time to take capital gains. So can we accomplish any of the rebalancing objectives in the other accounts that, we can place trades in the IRA or the Roth IRA without any tax consequence? So that's where we tend to lean on those other account types to do some of the rebalancing work without triggering any taxable events in the process of doing that. We're also, trying to be mindful of that asset location. So I think in simplest terms, trying to position as much growth as possible in the Roth IRAs. That's an example.
Yeah. So let's just touch on that a little bit. So if a portfolio or a client, you're working with a client that comes in and they have money in all these different types of accounts, one of the ways you may want to look at it, people do this in different ways, but you look at it from a total perspective. So if you have $1 million and you have a 50-50 portfolio and you have some money in a taxable account, some money in an IRA account, some money in a Roth IRA account, one of the things that we might suggest is that, hey, let's hold our most tax efficient investments, maybe S&P 500 inside of a taxable account, maybe more U.S. stocks and use funds or ETFs really that have lower turnover ratios, lower payouts. Let's hold those there. If we have a fixed income, we want to hold that inside of our IRA. That accomplishes two things. Typically those investments pay off ordinary income, so we can shelter that on a tax deferred basis. And we can also, I like to think of sort of keep that at a level where I don't want to say we want to hold back on our growth necessarily, but it will help minimize our retirement distributions in the future. If we had a really aggressive portfolio inside of our IRA and it did really, really well, you could end up paying a lot of ordinary income tax on those distributions in the future. So we like to look at bonds or fixed income inside of the IRAs. Jake, I'm going to let you go in a second. And like you just mentioned, the Roth IRAs, I think that's where we want our highest growth type investments in those.
Yes. Yeah, it's the rebalancing again. We talked about kind of the importance of thinking about rebalancing. Okay, it's conceptually we can talk about it in these simpler terms, but I think on boots on the ground implementation, it's unique to your situation, your mix of accounts, your allocation, your mix of different asset classes, and so forth. And we want to take advantage of that asset location. I think your first point was really important. From the perspective of your mix of accounts. Are there any accounts that need to kind of have their own separate allocation? They're managed for a specific objective. Otherwise, it's important to really look at your entire suite of accounts as one overall portfolio, and then kind of fine tune what's in each account based on a lot of the criteria that you were describing. I think one of the other criteria to mention is, for example, if you have a lot of assets in a 401k through your workplace, you're in most cases limited to the set of investment choices that are going to be available to you in your specific plan. And that set of investment choices, may lead you to make certain investment decisions and hold certain asset classes in that account. And then if you're looking at the entire portfolio and all of your accounts, you're kind of making up for where you're lacking in the 401k in some of your other accounts. So I think that's one important point to mention. But I think just back to my other one, which was you may have accounts that have their own specific objective. I think health savings account or 529 plan come to mind as good examples where, say, for a 529 plan, you're probably going to want to manage that allocation in a way that's specific to the college funding or education funding objective. And likewise with the health savings account, it's important to manage that specific to your ability to use those funds for qualified medical expenses. So you may want to hold a different proportion of, say, cash in that type of account.
Yeah, I love that point about the 529s. And the 529s have actually done a pretty good job of setting the plans up where people can simplify their investments and use these sort of targeted date funds where, it's very aggressive if you're investing for a child that's just born. And then the portfolio automatically becomes more conservative over time and is, maybe only has 20% equities in it when that child is going to college. So that's really two examples there that we've talked about earlier inside of 529. We're changing our total allocation, rebalancing, so we're becoming more conservative. It's like the life-changing events that you talked about earlier. But also inside of that portfolio, there's a mix of stocks and different asset classes and so forth. And so as those change over time, the percentages also change, and there's small adjustments being made there. So that's a great example of tying your rebalancing objectives into specific accounts.
Mm-hmm. And again, I think that example echoes kind of our, kind of starting definitions for rebalancing, which is controlling risk. So, you're rebalancing and maintaining your allocation in the 529 for a specific objective, and you're controlling for risk along kind of this glide path or time frame towards needing the money.
Yeah, and the I'm just going to touch on these age-based funds or these target retirement funds. I think they're really good in theory, and in a retirement plan, in a company retirement plan, I think they're definitely serve a purpose. When you get into having multiple accounts, I think there's some advantages to breaking those down essentially and holding specific funds in specific accounts, because then you can be more tax efficient when you're rebalancing and you're growing your portfolio, but also when you need that money to take it out, you can actually look and pick individual investments instead of having to sell just that one investment, which could create some gains.
Yeah, that's a really good point. Back to kind of that rebalancing for, your distribution or your cash needs. If you have a single investment choice, like a target date type of mutual fund that you'd commonly find in a, say, workplace retirement plan, and you need cash, you have to sell that entire position. And it's pro rata, kind of what's being sold across, all the different asset classes that you own in that single fund. Whereas you can be much more fine-tuned and selective in, kind of rebalancing for cash needs if you've built a portfolio using kind of component or asset class funds to do that.
Yep, you got it. And if we were at that cocktail party, I doubt anybody would be talking to us anymore. It would just be you and I left talking about this.
It'd be us in the corner talking about this.
As a matter of fact, this is probably the first episode we're going to get done with under 30 minutes. So it's even not that exciting for us. So,
well, maybe I'll keep us in a minute later because I had a little fun with the dictionary.
Okay.
And I thought of the definition for balance. So we're talking about rebalancing. Okay, we're bringing it back to balance. But what is that definition of balance? And I was kind of thinking about it in my head. How would you define balance? So as a verb, to balance means to keep or put something in a steady position so that it does not fall. And I really liked that particular definition of to balance as a verb because rebalancing, this is an action, this is something we're doing in the portfolio, and it's holding the portfolio in a steady position and to control for risk so it does not fall. And I think the idea kind of holds true. So I like the definition that I found for balance, and I thought it kind of resonated with really what we're trying to accomplish with something like rebalancing.
Yeah, thanks for adding that because I actually, that sounded really good to me the way you described that balance. And obviously it could still fall, but you just don't want to be in a position where the market does go down significantly and you said, oh, I forgot I was, way too overexposed to the equity markets. So it is something to think about. And, and as investors, we tend to get complacent when the market's doing really, really well. Rebalancing is really hard to do when the market's doing well because you don't want to miss out on the performance. And when it's even harder to do? And when the market's going down, because what you're supposed to do is actually buy into the market. And that both of those, it's counterintuitive, the right word. People tend to,
it's hard.
It's very hard. Let's just stick with that because the market's going down. You think it's going to go down forever. You don't want to buy anymore. Why would you want to buy anymore? The market's going down. And the same thing when the market's going up. Why would I want to sell this when the market's going up? And so, so keeping that balance and keeping you in a position where you're not overexposed is really, really important to having a successful investment experience.
Oh, it really, I'm glad you mentioned that it's hard because it really is. And I'll just mention the one thing that kind of always sticks with me. Rebalancing can be, I'm not much of a gardener, I would like to be, but in some ways it's kind of like deadheading your flowers. So you've got flowers, they could potentially bloom for months, but you kind of have to deadhead them, right? You have to pull off the flowers that have bloomed and are starting to die off, so that you can make way for the new growth and the new blooms. And I think rebalancing in a lot of ways, I like that analogy. It can be hard to do because you might have to take away from some of the appeal of your flowers as they are, but you're making way for more blooms in the future.
Well, Jake, I always learn something in this podcast, and it has nothing to do with investments. You always give me some knowledge that I had no idea what deadheading meant, and I'm not a gardener, so I appreciate that feedback. All right, folks, thank you so much for tuning in. As always, any feedback or topics you have, please suggest them. And thank you.